Want to continue our markets conversation now and bring in Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeffrey, good to see you as always. So what is your reaction to that hotter than expected read on inflation this morning?
Well, we're seeing this rotation in the markets. It's interesting. Airlines, the worst performing industry group in the S&P 500. So inflation is certainly weighing on the market, but so is this concern about the Delta variant and travel and this reopening trade, which is also in the background of all of this. But I think what's interesting is if we take a look at inflation, a lot of the drivers are global. We know commodity prices are global. We know the port traffic log jams and supply disruptions have been global. But inflation hasn't been. Here in the U.S., we learned this morning, core CPI is 4.5% on a year-over-year basis. That's certainly above the Fed's target and above the 5-year average. But in Europe, it's 0.9. And that's below the ECB's target and below and right in line with the 5-year average. In Japan, it's actually negative. Core CPI is negative 0.2. And that's why the European Central Bank and the Bank of Japan are not under pressure to make any moves, unlike the Fed. So policies are beginning to diverge between the Fed and other central banks. And that tells me, one, better than expected economic data in the U.S. may not be good news, particularly as it relates to jobs as it impacts the market, but it may still be good news overseas, tempered by the risk of a stronger dollar.
So are we saying then that inflation pressures are not the same overseas as they are here? And what does that mean, though, for the global economic recovery, I guess would be the question.
Well, it means, when we saw the pandemic strike, we saw every one of the world's central banks immediately cut rates and engage in a lot of quantitative easing. But the other side of this V-shaped pattern in the economy isn't going to mean the same thing for central banks. So meaning that not all the central banks around the world are going to be tapering and hiking rates at the same time. It means that the Fed may embark on some tapering later this year, but that may be pushed out till next year or even the year after for the ECB and the BOJ. And they may not get around to hiking rates for quite a long time, even if the Fed does pursue them in 2023. So the removal of all of this monetary policy stimulus may be very gradual as opposed to this sort of V-shaped immediate dramatic cuts at the beginning of the pandemic. And now that we've come out of it, immediate rate hikes and tapering. And that should be good for global growth. It means that we're not going to see a sudden removal of the support, maybe as we did in the mid-90s or other mid-cycle environments that saw very aggressive moves by the world central banks.
But what about this idea of inflation being temporary, which the Fed seems to continue to hang its hat on? I mean, we're seeing a number of big name companies, Jeffrey, like ConAgra and PepsiCo's CFO was on the show earlier today talking about how they're going to have to start raising prices. General Mills, Constellation Brands. I mean, with those kinds of consumer goods, those prices rising and wages rising, should we start thinking that inflation is going to stick around here for a little longer and perhaps not be as temporary as the Fed is telling us?
In the U.S., where you are getting that wage feed through and where companies aren't talking about price increases sticking, yes, we think inflation may settle into that 2 to 3% range that I think the Fed will be comfortable with after we get past this initial surge in inflation, really tied to easy year-over-year comparisons. And of course, those issues I mentioned with commodities and supply chain log jams. As those ease, I think we'll see inflation settle into that range. That's much higher than what we experienced from 2009 to 2019. So it may feel abnormally high to some, but for many of us, it's kind of a return to normal of seeing inflation in that range. And I think markets can still function in that range. I don't think that's a big negative for equity valuations were inflation to rise to that level. But we do have to watch, of course, if inflation, as it tends to do, gets out of control and rises significantly above that. That could be a big negative and result in a double dip recession that, currently, hopefully, no one's pricing in.
So what should we be pricing in, Jeffrey, when it comes to inflation? And how should investors be thinking about hedging inflation, even if it is indeed temporary?
Yeah, well, I think that environment of a 2 to 3% range for inflation, I think how you want to be positioned for that is to take a look at areas of the world that benefit from higher inflation. And these are often areas in commodity driven areas, in areas where we know historically they've been able to pass on price increases. These are areas like staples, which we're seeing are performing okay today, but it's also some commodity sectors which are not performing. Other areas you could look to are areas that generally don't worry much about pricing. They're more driven about quantity, and that's healthcare. It's actually our one overweight sector is in the healthcare space, finding that more the outlook for increasing quantity consumption of healthcare is far more important than the pricing issues, and it generally doesn't follow inflation anyway. So that's one way you can take a look at that. The other thing is to take a look at your entire yield on your portfolio, including buybacks and dividends on the equity side. I think increasingly we've noticed that buyback beneficiaries, companies that have announced buybacks in the last couple of months, have been outperforming. Last cycle, they outperformed for 5 years once we kind of began the economic recovery. We're only about 6 months into that now. So that's something that could have some long legs as shareholders really consider where they get yield in their portfolio.
All right, Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Good to see you.